Hey YouTube, this is Zach with Achilles Financial. Today I want to talk to you about different option strategies that I am actively utilizing to make money even when stocks are going down. So there's three key strategies I want to talk about today. The first, very simple, buying puts, again utilizing options. The second would be selling credit spreads, where you are buying one option and selling another closer to the money. And third would be selling covered calls. So today I want to first start by talking about AMD because it's a stock that has a lot of momentum. There is a lot of volatility both up and down. It's what I would classify as a big mover, and for that reason it makes a effective use of this strategy. One other key reason why I really like the stock is because on the same weekly options you can see that you can buy in increments of 50 cents, which means that if you want to purchase or sell an option, you have the capability to do so with small amounts of money. So to put that in perspective, to be able to do this trade right here, you would be able to, or you would only need to have $50 to do this trade right here. That's not going to get you any money though. So if we do 98, so for this option right here, it will cost you $50 a share, $50 to hold, and it will give you $2. So while that doesn't sound super exciting, that is a whopping 4% return. Now, before I get you excited about this potential 4% return, I do want to highlight that you will have to pay for the option trade right here of 65 cents if you're using Thinkorswim via TD Ameritrade, which means you'll only get 70 cents. And 70 cents is a lot to put, or not a lot, when you may end up having a huge premium call if the stock shoots up over 90 by the end of the week. But if you want to know when I'm personally making trades, allow me to show you the Discord down here below. So this is an example of when I was trading Tesla this past week and I was tracking it on the way down. And again, I was building out spreads, playing the volatility. This is not how I would recommend most people do trades because again, there is a lot of movement right here and I was making them free. Whereas if I had just looked away and just held it, I would have ended up being much better off. That being said, sometimes it's a little bit easier to watch the trades develop ahead of you and make them free. Because again, free money has never hurt anyone. What I'm going to be looking at here though is how can I replicate this, because all of these trades were made in a single day. How can I replicate this going forward on a repetitive basis? So feel free to check out the Discord in the description below, and you can see all of the group in here right now. So what I'm going to be looking at going forward is AMD, some of the different strategies. The first and foremost is going to be buying a put. So let's go, because I don't like to do end of the week. Let's go into the March 12th. So as you can see, Thinkorswim gives me a nice graph that I can showcase the good, the bad, and the ugly. So your total exposure for this trade right here for this put, which right now the stock is trading at $84 a share. So let's say $83. This trade is going to cost you right at $180. That is your max risk. So if you put this on the line and you don't touch it, and the stock does not go below $83 a share, you will not get the shares and you will lose $180. So you can see that happen right here in any of them. Again, in the top left-hand corner of the screen, you can see that. The reason why options are attractive to a lot of people is look at that balance go up as soon as I hit that green, where, hey, if the stock goes down to $80 a share by next Friday, that is pretty good because I will walk away with $115 a share. Or sorry, $115, because an options contract is a set amount for the contract of 100 shares. So $1.80 that you see above will actually translate to $180 cost. And so as you can see here, if the stock ends at $80 a share, I will walk away with right at $115 in profit, meaning it'll be a total position of $295. The exciting potential of options is that the stock could drop all the way down. Again, you can see here, it drops down to $73 a share. I walk away with $780 of profit, which means that it is essentially what would that be? Right at a 9x return. So that's the exciting piece. And again, I would say that that is not a regular occurrence. Otherwise, I would be doing a lot more trading. What you can see here, though, is there is potential, and on some of these high movers, there's a lot of potential to capture some of that premium. Rather, what we're looking to do here, though, is buy for some of these farther out of the money. So if you catch a 80, that 80 is only going to cost you $84. If the stock begins to drop and this premium goes from 84 to 90, you can then flip it immediately. So that is what this blue line is representing on this graph. So if the stock drops down another 50 cents and that stock premium goes up to, you can see a profit here of $9.68, that would be right at this premium of $95 per option. You could turn around and sell it, and that would be a quick 13% return on your investment. And the other side of this that I like to do is I like to purchase this option and then send it into a debit spread where you add the second leg, you sell the farther out of the money. So in this case, it would be the 79 put. And you can see here that if that move goes $10 farther the other direction, instead of paying 18, my exposure here is $8 a share, which will look like this, which means my total risk is $8. And if the stock goes under $78, right at $80, you can walk away with $92 of profit total. Although right now it'll still show, hey, my profit right now is still $8. So this is the power of getting into these spreads, and this is why I really like to utilize spreads. So buy one option, wait for it to move down a little bit, sell the other one. That's the strategy I use. And that's what you saw why there were so many trades on Tesla. Because they're such a big mover, I didn't want to be on the wrong side of a reversal. Now, what can we do with AMD in this situation? So there's a few other ways that we can, or there's a few different ways that we can do options trades here. The other one would be a spread. So if the stock is going down and you want to make money off of it, not just buying the put, let's take advantage of that premium. If you say there is no way that, or we haven't seen them go under $78 a share, let's go out for next week, go for that put, go down to the 78, where again, we haven't seen them in a long time. And then we want to have a second put again next week. We want that to be at least one farther out. So that will be 77. And to do this trade, you'll have to sell the one nearer the money. The money right now is $84 a share. So as you can see, I am selling a spread. That spread gets created here where I will walk away with $6. However, I get that $6 all the way up until the price hits $78 a share, or really 79, and it starts going down from there. You will need $100 of collateral to perform this trade. The important thing here, or the capabilities that this will provide you, is it will allow you going forward to be able to make a trade or utilize this $6 that you get paid. Again, you just have to hold that 100. Now, if you're like Zach, I don't really want just $6. You can obviously make that change. You can get $41 for the $80. Again, you can kind of mess around with these and see what the benefit is, $17. The idea behind this is a high probability trade, meaning it's unlikely that you lose on this trade. However, that is why the risk here is so much higher. So there's a lot of advantages here, a lot of capabilities, but this is a great way to approach the stock right here. This is, again, another reason why I'm personally a big fan of credit spreads. The only downside is you have to win. Again, I don't know if I'd take the $17 one here. You have to win at least 2 out of 3 times to make sure that you don't lose on these plays. So if we were to go to the 83, which this one is a little dangerous, and do the 81 right here, so $200 trade, $65 for a win, $135 for a loss. So something like this is what I'd be looking at, because you're probably going to lose 1 out of every 3 depending on how you trade. But this is another way that you can make money. $65 on an initial investment of $300 over the course of 10 days is a very healthy return of right at just under 25%, or just over 25%, right at, we'll call it that. So again, that's not going to be perfect math. So I'll do that for you real quick. We'll call it 15%. But again, high probability trading, it'll help you out in the long term, especially when the stock is going down. You can also do this on the call side. Lastly, the other way that you can do this is if you own 100 shares. So you will need to own 100 shares. You can sell a call. So the only time you should ever sell a call is if you have the underlying 100 shares. So you can see that if you are selling a call, let me pick one of these options that I have a 100 shares of, so TSM. If you were to sell a call right here, saying the stock will not be above this in maybe not 3 days, let's do next week. So right now the stock trades at 126, I could do 130. If the stock does not go up, I get to keep this $152 that you see right here. However, if the stock goes over $130 a share, I have to sell my shares at $130 a share, and that's when you can lose because, again, the stock could skyrocket up. However, this is my favorite strategy that I use all the time, and you've probably seen videos on my channel because it gives you the capability to take advantage of always making money even if the stock market isn't going up. Again, you can always buy this option back. But this is 3 different option strategies that I personally utilize to make money even when stocks are going down. So let me know in the comments below if you found this helpful, and if you liked it, please leave a like and subscribe, and feel free to check out the Discord. So thanks for watching. I will talk to you all soon. Thanks.